Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Ever wondered why some investors seem to pick winning stocks again and again while others keep tossing money into what feels like a bottomless pit? This is where fundamental analysis steps in, a method that tries to strip away the market hype and focus on what's actually under the hood. Think of it like dating. You don't just pick someone because they dress well. You want to see if their values, lifestyle, and finances match your ideals, or if you're just falling for the fancy clothes. Fundamental analysis aims to figure out a company's true value by examining its financial statements, management quality, and the broader economy. Many people confuse this with technical analysis, which is more like reading tea leaves or candlesticks, trying to spot patterns in stock price movements. Fundamental analysis goes deeper into the business itself, and while it isn't perfect, it's often considered the backbone of long-term investing. So, how do you get started? First, you need data, lots of data. Where to get it? Publicly available resources like Yahoo Finance, Morningstar, or Seeking Alpha usually offer company snapshots that let you quickly see metrics like earnings, revenue, and even handy valuations. For the real nerds among us, you can dive into annual or quarterly reports, because if a company's bragging about big profits, you might want to confirm that's not just marketing fluff. Once you get the hang of reading a balance sheet, you'll realize it's like deciphering the hidden clues in a treasure map, except the treasure is hopefully a profitable investment. A quick way to start evaluating a stock's price is by looking at the PE ratio, short for price to earnings. Picture it as how many dollars you're paying for each dollar the company earns. A high PE might mean people expect the company to grow fast, or it could mean the stock is just super overpriced and the CEO's been tweeting fancy promises. A low PE might suggest a bargain, or it might mean the company is the corporate equivalent of a zombie crawling toward its final resting place. The key is understanding whether that ratio is justified by the company's future prospects and comparing it to peers in the same industry. Next up is the PB ratio, price to book. This is a cool one if you're looking at businesses heavy with tangible assets. It essentially compares the stock price to the company's net assets, the book value. Some classic value investors love picking up stocks where the PB is under 1, because theoretically you're buying assets cheaper than their accounting value. Then again, if a company's main asset is a brand or intangible intellectual property, PB might not be super illuminating. It's like measuring the attractiveness of a social media influencer purely by the cost of their camera gear, only part of the story. Now, if you want something that tries to factor in growth, check out PG, or price/earnings to growth. It basically takes the PE and divides by the expected earnings growth rate. The idea is to see if a company's growth justifies its valuation. If your date claims to have big ambitions, you might want to see if that drive matches their current situation. Is it just talk, or do they have a real shot at doubling their income next year? Then there's ROE, return on equity, which measures how well a company uses shareholders' money to generate profits. Everyone loves good ROI, right? Think of ROE as the efficiency rating. If you give someone $100, do they turn it into $110 or $1,000? High ROE can be a great sign, unless it's artificially inflated by a mountain of debt. So it's wise to keep an eye on how that ROE was achieved. A company that's borrowing to the hilt to boost returns might be in for a rude awakening when the debt collector comes knocking. Speaking of other numbers to watch, there's more to fundamental analysis than just these big ticket ratios. Earnings per share, EPS, EBITDA, return on assets, ROA, return on capital employed, ROCE, each can shed light on different facets of a company's health. The deeper you go, the more your friends might roll their eyes when you start talking about EBITDA adjustments at this year's annual meeting. But hey, who needs party invitations when you can admire the intricacies of a corporate balance sheet? And that brings us to the wonderful world of debt. Sure, debt can help a company expand, buying new factories, hiring more staff, increasing production, but too much debt can sink the ship. Keep a close eye on metrics like debt to equity, which shows how leveraged a company is. A high ratio might mean the business is playing with fire, especially when interest rates rise. Another clue is the current ratio, indicating short-term liquidity. If the company can't meet its short-term obligations, it might be time to hide your wallet, because that next share issuance could seriously dilute your holdings. But what if you're the type who likes to see money coming in on a regular basis? That's where dividends and the dividend yield come into play. Some investors love companies that reward shareholders with a consistent payout, like a monthly subscription box, except hopefully more profitable. A high yield might be tempting, but it can also be a red flag if that payout is unsustainably high. The real question is whether the dividend is well covered by earnings or just a short-term ploy to attract starry-eyed investors. If a company's dishing out more than it earns, that sweet yield might end abruptly. Of course, crunching numbers isn't everything. You might have the sexiest balance sheet in the world, but if the CEO is better at partying on yachts than running a company, watch out. Quality of management is crucial. Reading up on the leadership team's track record, strategy, and how they handle crises can be just as revealing as any ratio. Sometimes you can even catch glimpses of corporate culture in the statements they make at shareholder meetings. If their grand plan sounds like a fairy tale, you might want to see how they've historically performed before you buy into the magic. Then there's the bigger picture, the macroeconomic context. Even a solid business can struggle if the industry is in decline or if the broader economy hits a major recession. Oil companies might face headwinds if the world shifts faster toward clean energy. Tech companies might soar if everyone's stuck at home streaming movies. You can't just look at a company in isolation. Consider industry trends, economic cycles, and consumer behavior. Sometimes a company is doing all the right things, but it's like opening an ice cream shop in Antarctica, conditions matter. Now, how do you compare different companies using all these numbers and insights? You can line up their P/E, PG, ROE, debt levels, and so on to see which one stands out. But keep in mind that different industries have different standards. A tech startup might have a sky-high PE if investors expect rapid growth. A utility company with stable cash flows might have lower multiples because it's considered boring, though boring isn't necessarily bad if you like stable dividends. The trick is to interpret these metrics within the right context. But let's be clear, fundamental analysis has its limitations. The future is unpredictable, and even the best data can't guarantee success. We're dealing with people's perceptions, unexpected geopolitical events, supply chain disruptions, viral memes, you name it. Plus, some companies excel at creative accounting, making those pristine financial statements look a little too good. If all that wasn't enough, you can do the best research of your life only to have the stock plummet the next day because an influential blogger said it's doomed. Welcome to the stock market, where your well thought out logic might get overshadowed by a tweet. To bring this home with a simple example, imagine you're analyzing a fictional burger chain that claims to make the world's best veggie burgers. You go to Yahoo Finance and see the PE is slightly above average, but the PG is reasonable because analysts expect big growth in the plant-based food market. The ROE is solid, but you notice the company took on a hefty loan last year to open more locations. Checking the debt-to-equity ratio, it's higher than you'd like, but not terrifying if those new locations become profitable quickly. Then you skim the management's track record. They have successfully launched several other food brands before, so they know the industry. Dividends are minimal, makes sense if they're focusing on expansion. Macroeconomically, plant-based foods are on the rise. You decide it might be worth the risk, but you stay alert because one piece of bad news about veggie health concerns could send the stock into free fall. That's the balancing act. The numbers look promising, but risk is always lurking. So what's the takeaway? First, fundamental analysis is all about understanding what you're actually investing in beyond just the hype and the chart patterns. Second, it's not just about one ratio, but a combination of factors: valuation, growth, efficiency, debt, management, dividends, industry trends, and the broader economy. Third, none of this is foolproof. If you want certainty, put your money under your mattress and hope inflation doesn't gobble it up. But if you're willing to do your homework, fundamental analysis can be your compass in the chaotic sea of the stock market. You may still get tossed around by waves of speculation, but at least you'll know there's a sturdy ship beneath your feet. And yes, you can still keep an eye on technical charts for short-term trends or market timing, but remember that a gorgeous chart pattern means nothing if the company behind it is on the verge of bankruptcy. Ultimately, the goal here is to find gems that are actually worth more than their current market price, a concept also known as intrinsic value. You're trying to buy a dollar for 70 cents, as the saying goes, while making sure that dollar isn't about to shrink into 50 cents. That's the allure and risk of fundamental analysis. You're searching for real value where others might see noise. So go ahead and dig deeper into those financial statements, quiz the management team's background, and pay attention to broader market conditions. Some folks might find it dull, but it's often the difference between gambling on a hunch and making a calculated bet. And who knows, maybe you'll stumble upon a future giant while it's still quietly growing in the background. Just don't blame me if the market does something ridiculous in the meantime, because, well, that's what markets do. Good luck, and remember, invest responsibly, or at least keep enough petty cash for that late night pizza when the market gets you down.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you, and take care of yourself and your finances.